Example 3, the present credit terms of X company are 1% discount will be granted those who are settled their money within 10 days, and total period is 30. Its sales are rupees 80 million, current sales 80 million. Its average collection period is 20 days at present. Its variable cost to sales ratio, sales are 0.85, V equal 0.1, 0.85, and its cost of capital K is 10%. The proportion of sales on which customers currently take discount 0.5, P note 0.5. The company is considering relaxing its discount terms into 2, 10, and 30. Such relaxation is expected to increase sales by 5 million, reduce the average collection period to 14 days, and increase the proportion of discount sales to 0.8. And the company's tax rate is 40%. Compute the effect of relaxing the discount policy on residual income. And yeah, so we have discussed, no, the last class we did this one, we did, and we have to, yeah, and, right, it's a collection effort, no. This is the formula. I think we did this question in the class, so yeah, we did, and this is what we have to discuss from today's class. The collection program may consist of the following: monitoring the state of receivables, dispatch the letters to consumers whose due date is approaching. Right, some customers are not paid their money on time, so from company side we have to send some reminding letters. And electronic and telephonic advice to customers around due dates. Right? We sometimes in company side we have to send some email and make some calls. Sometimes you may receive this kind of calls from the dialogue company, dialogue and Mobitel like that. And the legal action against overdue accounts. If some customers will does not have idea to settle their dues, that time we have to take legal action. It's a collection efforts, right? Some companies are very serious on customers' credit. Some companies are giving flexible, right? Uh, so it's based on the attitude of the financial manager. The effect of decreasing the rigorous of collection program on residual income may be estimated as follows. Right? When you give some fluctuation to your customers, you may expect some sort of increase in net sales. Such will contribute on increase in residual income. It means very tight collection policy versus flexible collection policy. Assume that at present you are at a very tight, very rigid credit policy. Now you are considering relaxation of that collection policy. So how do we calculate this? Changes in residual income equal changes in sales 1 minus VS ratio, minus changes in bad debt. It's obvious, no? When you become flexible on collection effort, some customers will not pay. Then it comes bad debt 1 minus T, and K cost of capital, changes in income. Changes in income here, changes in I equal 360 days into sales, initial sales, average collection period, new collection period, and average collection period earlier, initial one, plus 365 days, the changes in sales into average collection period, new V. And bad debt equal BN, the new, it will give it, right? And the initial sales, changes in sales, B note, S note. That we will get a snapshot on this formula. This is the formula, then we can copy the Excel sheet. This is the formula, and this is the question. I think all of you can see this. All right. Now we will extract information from this question. Average collection for ABC company is considering relaxing its collection effort. Its sales are 40 million. Is not, is not, is not equal. How much? 40 million. And its average collection period, average collection period initially it was 20 days, and its variable cost to P equal 0.8, and its cost of capital K equal 0.12, and its bad debt ratio is 0.05, BD, B not 0.5, 0.05, and relaxation in collection effort is expected to push sales by 5 million. Right now, new sale is delta sales. Right, delta sales is now 5 million, and an average collection period to 40 days. Now it's become 40 days, and raise the bad debt ratio 0.06. Tax is 40%. Right now, we'll see how do you calculate residual income. So the formula is this. First, we have to find delta. We need delta Ri, and we need delta I, and we need delta BD, right? And first we will find DI, right? DI equal DI equal, how to calculate? First we have to get D, DI equal here. It's not how much? It's not 40 million, no? S naught is equal to 40 million. It should be divided by 360 days, and average collection period new. How much? How many days? 40 days minus average collection period initially 20 days. Right, then we close the bracket. Right, and plus changes in sales 5 million. It should be divided by 360 and multiply by average collection period new, that is 40 days into V 0.8. That's DI equal this value. Right? Any questions? Right. If you have any clarification, please stop me and ask. Right? And this is the final day. So if you have any clarification, please, without wasting your time, please ask. And BD equal PN, that is equal 0.06, and S naught is a 40 million plus delta sales, that is 5 million minus B naught is 0.05 into 40 million. Right, that is equal 2000. Right, now we move here. Right, equal bracket data sales, that is 5 million, 1 minus V 0.8. Right, minus delta BD, this value. Right, and minus sorry, not BD, into 1 minus T. 1 minus T equal 0.4. Minus K, that is equal 0.12, 1 2 into tilde I. Then how much the changes in residual income? Changes in residual income? How much? Is it profitable or not? Is it profitable or not? If relaxation policy is good or what's the answer? This one. Your opinion is what? The relaxation policy is good or bad? Profitable or not profitable?
Not profitable.
Not profitable because due to the relaxation of credit collection policy, our residual income will be lose by 140,000. This is how we have to take decision, right? So we are the financial management students, so we have to take decisions very scientific manner. So these are the methods, right? So we have to justify in this ways, and we hope we can move to the next question. Right, inventory management, the last chapter, inventory management. I don't want to discuss much on this chapter, this area, because all of you have experts having more knowledge in this area. Right. Inventory management, we will touch some areas. Inventory can be a large percentage of firm's assets. When you look at the balance sheet, statement of financial position, you can find uh, inventory at the top of current assets because it's a least liquid asset in the current assets. So there can be a significant cost associated with carrying too much inventory. When we keep too much inventory, we have to spend more money to maintain that inventory. So there can also significant cost associated with not carrying enough inventory. If we are not maintaining enough inventory in our store, we have to lose our customers to our competitors. It is called out of inventory cost. Inventory management tries to find the optimal trade-off between carrying too much inventory versus not enough. At the same time, if we are not keeping enough inventory, you have to order many times for the inventory. So one side, if you keep more inventory, you will encounter with higher carrying cost, and if you are keeping short a small amount of uh, inventory, you have to end up with loss of inventory, and you have to spend more order cost. So type of inventories in an organization. If you are a manufacturing organization, first raw material, so starting point production process, and the raw material become work in progress, and finished goods product ready to ship of them. Remember that one firm's raw material may be another firm's finished goods. Say rubber. If you take rubber, in Sri Lanka, we are cultivating a very well quality rubber. It's an output for rubber estate people, right? But the same thing, the rubber become an input for tire manufacturing organization, Kalani tires, right? Quality tires in Sri Lanka, quality tire manufacturer in Sri Lanka, Kalani, right? So the Kalani tires using output of uh, rubber estate, rubber Kalani tires are using input. Which one? That input rubber produced by the real rubber estate companies. Different types of inventory can vary dramatically in terms of liquidity. Inventory cost. Carrying cost, um, the range from 20 to 40% of inventory per year. Carrying cost, so here in terms of inventory cost, it takes 20 to 40%. Store and tracking cost, insurance and taxes, losses due to obsolescence and deterioration or theft, opportunity cost of capital. So when we are keeping more inventory, this means we are keeping our money in the form of inventories. So there will be a opportunity cost. We tied up our capital. Shortage cost. If you don't have any enough inventory, uh, restocking cost and lost sales or lost customers. Consider both type of cost and minimize the total cost. So if you are a good financial manager, you have to minimize the carrying cost of inventory as well as shortage cost. Those two are carrying cost and shortage cost are two contradicting behaviors. When when we try to increase reduce the carrying cost, shortage cost will increase. And try to reduce the shortage cost, carrying cost will increase, like that. Inventory management, so ABC. So one kind of techniques you might study in cost accounting. So first under the ABC system, first classify inventory by cost, demand and need. There are three types, A, B, C. Those items that have substantial shortage cost should be maintained in a larger quantities than those with lower shortage cost, and generally maintain smaller quantities of expensive items and maintain substantial supply of less expensive basic materials. Right, EOQ, very familiar equation to you all. The EOQ model minimize the total inventory cost. The total carrying cost equal average inventory, into carrying cost per unit. So in mathematical terms, Q average Q EOQ. No, sometimes you can EOQ divided by 2, then you will get average inventory carrying cost. And total restocking cost, it's mean restock mean ordering cost. Total ordering cost equal fixed cost per order into number of orders. So how do we find the order number of orders? First we have to take the total demand for the year and should be divided by EOQ. Then we will get number of orders, then fixed cost per order. Total cost equal total carrying cost plus total ordering cost. Right. So this is the formula. Q, EOQ, economic order quantity equal to DCO over CH. 2 D mean annual demand, here T, right? T, and fixed cost here, not fixed cost, ordering cost. Yes, CC mean carrying cost of holding. See the figure. When we keep more inventories, we can minimize the reorder cost, restocking cost, reorder cost we can minimize when we keep more inventories. At the same time, when we keep more inventories, we have to spend high amount to carrying cost as a carrying cost, right? Store, AC charges, security guard, insurance in the forms, it will incur. And the point intersect this point where the total cost of holding inventory is minimum. The total cost of inventory include both carrying cost and ordering cost. Right? Example, consider an inventory item that has a carrying cost of 1.5 per unit. Cost of holding is 1.5 per unit. And fixed order cost is 50 rupees per order, and the firm sells 10,000 units per year. So what is the economic order, EOQ? Here we take 2, and annual demand here is 1,000, and cost of order is 50, is fixed, and cost of holding. equal, so 2582 units. In the order, it should keep 2582 units. If we order for this unit, we can minimize both carrying cost and order cost. Here, safety stocks. Safety stocks mean people are having motorbike and car, right? Reserve, no, we call it reserve. So in emergency purpose, right? So in our home, sometimes we use emergency lamp, emergency light, for what? In case of urgency. So safety stocks for the safety purpose. Safety stock, a minimum level of inventory keep kept on hand. So it increases carrying cost. When we keep more safety stock, it will increase our carrying cost. And reorder point, at what point, at what inventory level should you place an order? You need to account for a delivery time. So derived demand inventories, materials required plan MRP. So just in time, you might study in other subjects. And quick quizzes. So what are the key issues associated with credit management? What are the cash flows from granting credit? How would you analyze change in credit policy? How would you analyze whether to grant credit to a new customer? What is ABC inventory management? How do you use the EOQ model to determine the optimal inventory level? I hope all of you can answer this question, right? This is end of working capital management and my session. If you have any clarifications, you can ask. Any questions? Any questions, please?